Kim, remember the good old days when you worked for a company for 40 years and retired? You didn't only get a gold watch, but you also got a pension, monthly checks for the rest of your life.
Well, Kevin, that was way before my time. But instead of talking about the past, let's talk about the future. Many of tomorrow's retirees don't have a pension, and many who do won't receive enough monthly income to cover their bills. That's when annuity comes in. It can help you provide the income that you need.
So, Kim, just what is an annuity?
Well, there's two types of annuities, deferred and immediate, and they're both sold by insurance companies.
Okay, what's a deferred annuity?
Well, a deferred annuity is a savings tool, oftentimes called an accumulation annuity. You invest a certain amount of money that grows tax deferred until you need it in retirement.
Okay, but that's not what we're here to talk about. We're here to talk about immediate annuities.
That's right. Immediate annuities are called income annuities or payout annuities. With those, you give the insurance company some of your retirement savings, and they promise to make payouts, often monthly, for the rest of your life, no matter how long you live.
Is a lifetime payout the only option?
No. In fact, you have many options. You could get a joint annuity, which provides payouts as long as you and your spouse live, or you could get an annuity that guarantees payouts for, say, 20 years. So even if you die before then, your wife and kids could keep getting checks.
So it's a lot like that old pension we were talking about. You retire, you invest some money with an insurance company, and you get checks for the rest of your life.
Well, that's right. In fact, many companies cover their pension obligations by buying immediate annuities for their employees, so the insurance company can deal with the mechanics of investing the money and making the payouts.
Now, I've heard some people call annuities life insurance in reverse. Why is that?
Well, it's because it's exactly how it works. With life insurance, you're buying a policy to protect your family if you die too soon. With an annuity, you're protecting yourself from living too long. That's outliving your income.
Well, that's right. With a life insurance, you give the insurance company monthly premiums and your heirs get a lump sum when you die. With an annuity, you give the insurance company a lump sum and they give you monthly payments for as long as you live.
That's right.
It must be awfully expensive to get that kind of guarantee. I suppose investing some of your retirement savings in an annuity means accepting a lower standard of living in exchange for that guarantee that you'll never run out of money.
Think again, Kevin. Actually, studies show that retirees who buy an annuity not only have the peace of mind knowing they can't outlive their income, but also have more income to spend in retirement.
Now, that sounds like magic. And Kim, you know I don't believe in magic. What's going on here?
Well, to understand how it works, you need to look at the big picture of how you translate a lifetime of retirement savings into a lifetime of retirement income.
Mary Beth, can you explain to me how somebody can both buy an annuity and have something left over for their heirs?
Oh, sure. You would never use all of your money to buy an immediate annuity. So right there would be other assets to leave to an heir. And in fact, most people who buy an annuity choose an option that continues to pay after they die. For example, for as long as their husband or wife is alive, or for a certain number of years.
Okay, and that other misunderstanding you mentioned?
Oh, the thought that the insurance company keeps all the money that you lose if you die before you recoup your investment. In fact, it goes to annuity owners, including you, in the form of a bigger payment than you could have gotten if you were using the 4% rule alone.
So this helps explain the higher return.
Sure, it's just like other insurance where people pool their risks. For example, sick people benefit from the health insurance premiums paid by healthy people.
Okay, and people who are in accidents, the settlement's funded in part by people who pay auto premiums but never have wrecks.
Right, and people who buy annuities get higher payouts than they could have on their own.
Okay, Mary Beth, you convinced me about the important role an annuity can play. Since it can boost my retirement income, I suppose I ought to put all my money into annuities.
Oh, definitely not. You know, depending on your other sources of income or how much money you have, you might not need an annuity at all. And besides, you never want to put all of your money into one.
Well, why not?
Well, you want to maintain some liquidity in case of an emergency. Think of an annuity as part of your overall retirement investments.
Okay, I understand that the money I put in an annuity, I give up flexibility of investments in exchange for that higher guaranteed return.
Right, and with other investments, you maintain the flexibility, but you risk a lower return. So by looking at the trade-offs on both sides, you may be better off blending an annuity in with your other investments.
Do you have an example? Let's say I've got $1 million.
Okay, let's go back to that 4% rule. You could spend $40,000 the first year in retirement. But let's back up a minute. If you took a third of that $1 million and bought an annuity that paid out 8%, you'd get $27,000 a year.
Okay, and if you took 4% from the rest of the money, you'd get another $27,000.
Bingo. Now you've just boosted your first year retirement income from $40,000 a year to $54,000 a year. That's a 33% increase.
And half of that money is guaranteed for the rest of your life.
Plus, you have maintained control over the other 2/3 of your money that you can use if you need it, or you can leave it to your heirs if you don't.
Okay.
How does somebody decide if an annuity is right for them?
Carefully, and after taking into consideration and understanding all of the variables. And a good place to start is to add up all of the income that's coming in every month from Social Security or from a pension that you might be entitled to, and compare that to the expenses that are coming in every month for housing, food, clothing, insurance, taxes. And if you find that there's a gap, consider filling that gap with an income annuity.
So you want to cover your steady expenses with steady income.
Exactly.
Give me an example. Who's your typical client?
Our typical client is a retiree or someone near retirement, and their objective is to establish a foundation of guaranteed income for life.
Can you give me an example?
We recently had a widow who wanted to use part of the proceeds from the sale of her home to finance our monthly living expenses at a retirement community. Mm-hmm. Retirees are very typical, new retirees that is. They would take part of their 401k savings plan and use it to purchase an annuity to kind of establish a pension plan for themselves.
That's a really good point. How do you figure out how much of your savings to dedicate to buying an annuity?
Well, everyone's situation is unique, so when you talk about how much to allocate to an annuity, we should only talk about general guidelines. And the first guideline is not to allocate 100% of your assets to the purchase of an annuity.
Why not?
Because you're going to need cash for emergencies. And you're going to need funds to plan for the impact of inflation on your purchasing power.
What else should you consider?
An annuity is a contract for lifetime income, and it works best for those who live a long time. So you do want to consider whether or not you're in good health before purchasing an annuity. And you also want to consider the other people who are relying on you for income, your surviving spouse, for example. It might be a dependent child. It might be someone else to whom you want to leave a legacy. All told, we find that most retirees would benefit from allocating between 1/3 and 1/2 of their retirement assets to a retirement annuity, which they purchase either at once or over a period of time during their retirement.
You mentioned surviving spouse. How do you decide whether to buy an annuity that ends with your own life or one that will continue for the life of your survivor? I know the survivor option, the payout's smaller.
The payout is smaller because the annuity has to last for 2 lifetimes instead of 1. And as to how much of the annuity to continue to the surviving spouse, it's really the same income expense comparison we talked about a few minutes ago, but this time for the surviving spouse. Will the surviving spouse receive life insurance proceeds? Will she receive other forms of inheritance? And how do these assets and the income they produce compare to the expenses that she will have to bear? If there is a gap between expenses that are expected and income that's expected, you might consider filling that gap with a survivorship annuity.
What about single people? Do they have to worry about survivor benefits?
Well, single people have folks who rely on their income as well. So, yes, they should consider survivorship benefits. And as a matter of fact, many people would consider a survivorship benefit in the event they would to die a few years after purchasing the annuity.
What kind of benefit options do people have?
Well, the options range from continuation of the annuity for the life of another person, or continuation for a period of time, and that could be 5, 10, or 20 years, or a return of part of the premium in the event of your death.
Okay, Kim, let's get down to the nitty-gritty. I've decided an immediate annuity makes sense for me. What other decisions do I have to make?
Well, the easiest choice is a fixed life-only option, where you give the insurance company some of your retirement savings, and they send you a check for the rest of your life.
Okay, how is the size of that check determined?
Well, it depends on how much you invest, your age, and the prevailing interest rates. Since women tend to live longer than men, they tend to get lower payments.
I bet you've got an example.
I do. Say a 65-year-old woman invests $250,000 in an immediate annuity. She would get about $1,575 per month. A 65-year-old man would get about $100 more per month.
So women get paid less because they're likely to get those payments longer.
That's right, but there is one exception to this rule. If your 401k offers an annuity as a distribution option, then they may have unisex pricing, which could be a better deal for women.
Well, what about that survivorship option that Chris O'Flynn mentioned?
Well, that tends to be popular with married couples. After the first spouse dies, the surviving spouse continues to get payouts for as long as he or she lives. And in fact, with pension plans, federal law requires that married employees choose the joint and survivor option unless the spouse agrees otherwise.
So would the payment be the same after one spouse dies as it was when both husband and wife are alive?
Well, like so many things with annuities, you can choose. You can either have the 100% option or a 50% option, which means that the payouts would drop by half after the first spouse dies.
Well, what other choices can I make?
Well, you could pick, for example, a 20-year period certain annuity. That's like we talked about earlier, where the payouts continue for 20 years, even if you die before then, so your heirs continue to get those checks.
Kim, is there an easy way to see how choosing these various options affects the cost of the annuity?
Well, there is. There's several great websites. My favorite one is immediateannuities.com that lets you type in how much money you have to invest, and you'll see what monthly income you could get.
Well, what if I know how much monthly income I need?
You could do the reverse, too. You could type that in and find out how much you need to invest to come up with that monthly payout.
Well, Kim, is inflation protection built into annuities?
It can be, but that costs extra. Another way that some people do this is to ladder annuities. They buy an annuity at age 65 and then maybe buy another one at age 70 to help their payouts keep up with inflation.
Okay, and of course, the older you are when you buy an annuity, the more monthly income you can buy for each dollar you invest.
That's right.